all of that considered, what could this mean for your investment portfolio? Here with more, we've got Sandra Cho, who is the Pointwealth Capital Management President and Founder. Great to have you here with us today. Just walk us into your reaction, your thinking as you see that weaker than expected jobs print come out last week and how that pertains to the Fed's policy pathway from here, Sandra.
Great to be here. Thanks for having me. So yes, it's exactly what you said. It would be wonderful if the jobs report, which came out, which showed less than expected jobs out there, it would be wonderful if that brought down inflation. And that would mean that we would have, less, less inflation. It would mean that perhaps the Fed would be able to lower rates this year. However, I'm going to just let you know that here at Pointwealth, we don't see that happening anytime soon. I would say if it's going to happen, it would happen maybe one time this year because inflation has been quite sticky. So, it's something to hope for.
And so specifically, as people are looking across the jobs figures here, where does that ultimately point you to believing that we are going to be seeing perhaps a trend that the Fed is looking for? Where will that trend begin to emerge?
They're looking at numbers really daily, and they're looking at them very carefully. So hopefully jobs actually, as sad as it's to say, it would help us if the jobs or unemployment started to tick up more. If you have less jobs, then there's less people to buy things. You're going to be more careful with your dollars. And then that would bring the price of goods down, the price of services down, and that would bode well, enabling the Fed then to start considering a rate cut.
And so if we did see that rate cut become enacted, as of right now, we're looking at the potential for September being the highest first moment. And then additionally, we're looking out to December. There's also the apolitical nature that the Fed wants to try and signal as well here. How does that play into this?
So one of the things that we're looking at is a possible rate cut, maybe in September, maybe even later in the year. We would hope that there is going to be unbiased consideration as far as the rate cut goes. But there's always some kind of bleed into, as far as in consideration into what's going on right now with the presidential election races. That said, also, like I mentioned, we see jobs, unemployment ticking up, and then inflation coming down. That doesn't necessarily mean it's a bad thing. And let's remember that on a daily level, Main Street really looks at and can bode well for inflation coming down. You're going to be able to see prices coming down in the supermarket, in goods and services, and hopefully you're going to be able to, on a very personal level, save more. Because if you're not spending more as far as, just going out there, going to the grocery store, then you're able to save more both for retirement and your own personal finance.
Okay, so let's get to the goods here because a lot of potential and perhaps near-term retirees are trying to figure out how they can best position their portfolios. What is the investment advice or know-how that you're bestowing upon those who are getting closer to retirement right now, given the macroeconomic backdrop?
Sure. We see that the stock market has been going gangbusters last year and even year to date as far as large cap growth. And large cap in general. So big companies, but not all stocks are made the same. You see smaller companies like the Russell 2000 really underperforming. You see emerging markets at better valuations, and you see international developed markets like Europe at better valuations. And, that said, we're really looking to see more market participation as far as, equal market weight kind of coming back up. We're starting to really see that. For retirees especially, what's really nice is you're finally getting a decent yield in bonds. So if you're getting about 4.6% or so in bonds, and bonds have come down as far as price goes, about 2.6% year to date, if bonds just come back up to where they were January 1st of this year, you could potentially be looking at, if your entry point was right now, you could potentially be looking at a 7+% total return in bonds. that's really nice because you generally have less risk in bonds, less volatility. And that's especially good for retirees who tend to be more conservative.
Sandra Cho, who is the Pointwealth Capital Management President and Founder, thanks so much for taking the time here with us this morning.
Thank you.